Welcome to our Get Safe and Hot in One Easy Plan video conference. This is Natalie Pace, and we'll get started in just a moment. Today is June 19th, 2025, and with stocks at an all-time high, this is exactly the video conference that you want to be watching. Be sure to share it with your friends. They can join us as well. And if you want to find the exact link and you can't, email info@nataliepace.com. Thanks again. I'll join you. I'll be starting in just a moment. Okay, so let's get started. But I want to say is that it's actually not difficult to get safe and hot in one easy plan. It is difficult if you just have your, 401k and all you're doing is selecting from five different things. But there are solutions for this, and it's really worth it to get those solutions because chances are you're way more at risk than you realize and you're really underperforming. So I'm going to show you a few slides, and of course, I'll be coming back in to give you what they mean and what you can do about it. All right, so this is the perfect time to be actually checking this out. And the reason for that is that Wall Street is very close to its all-time high. It's only about 3% down from its all-time high that was actually hit just a few months ago, February 19th. The S&P is far outperforming the Dow Jones Industrial Average. So if you have, a Dow-based fund, and a lot of the choices that we have in our 401k are going to be more like the Dow than they are like the S&P 500. So this is important because it's not just a little bit, it's like double the amount, especially over the past couple of years. And if you add in technology, you might have been hearing the Magnificent Seven, right? So the seven stocks that are in the Magnificent Seven, like Google and Tesla and Apple and Meta and Microsoft and Nvidia and Amazon, all of these companies are really the ones that are leading the charge on Wall Street. And if you don't have large cap growth, then you are not participating in that spectacular growth. If you don't have the S&P 500, you aren't even coming close if you just have the Dow. So it's really important to understand. Now, if what I'm saying sounds complicated, it's not. It's like if you had never tried to read, the simplest kindergarten book and because you didn't know the ABCs, it would sound very complicated. This is way easier than a lot of the things we learn in a math class. So again, if we learn the life math that we all should have received in high school and we just set it up right, it's kind of like a house that you get to live in and you go in and you just live there and you're protected from any economic storms on the horizon and you can have great parties when things are going well and you don't have to worry about it as much. If you don't have your financial house properly set up, you really are vulnerable to any economic storms on the horizon. And we'll be taking a look at some of those things. But the first thing is definitely you have to have large cap growth so that you participate with the Magnificent Seven. Also, in our pie chart system, we allow you to have four hot slices. So, or we encourage you to. Of course, you're the boss of your money, you do what you want, but we encourage you to in our sample pie charts. And you could do anything in there. You can do the Magnificent Seven, which there's a fund called TECB, offered by iShares. You could do cryptocurrency in there. You can now do a trust within your IRA. So the capital gains, you don't have to go and give an arm and a leg to the tax man when you capture your gains. It also helps you to capture gains because the system is set up to do that. You could do cybersecurity, artificial intelligence. If you wanted buoyancy, you could do consumer staples. There's all kinds of things that you can do in those hot slices. So, are you relying on a target date retirement fund? Did you know just how low performing they are? So, this is a chart of this is a 2025 target date retirement fund. And the crazy thing about it is that, not only has it only earned like 1%, about 1.5% annualized, look what the S&P has practically doubled over that 5-year period. But it also is at risk of losing when the markets go down. So it's not protecting you. and it's not performing anywhere near where it should be. And we think, oh, well, it is going to protect me because if I retire at 2025, surely my money's not going to go down. But it's really not. So it's real important for us to be the boss of our money and to understand how we can make better choices. So this is the 10-year return. Again, that target date over the last 5 years is 1.5%. Over the last 10 years, large caps have done about 13% every year, right? So that is so far above that miserable target date retirement fund. So how do you increase performance in your portfolio? Well, if you look at the returns of Bitcoin in 2024, it makes that really incredible return of the S&P 500, which was above 20%, look very small, right? And then it was the same thing in 2023. The S&P 500 was gangbusters in 2023 as well, but Bitcoin was just a super performer. Now, the thing about it is that, cryptocurrency has severe crypto winters. What it tends to do is it shoots the moon. It might stay there even for a year, and then it can really plunge. So the last time we saw it plunge, it went from $69,000 all the way down to $15,000, and that was 2021 to 2022. So the losses were 67%, right? That's a lot of losses, right? $1 million could go down to, 300 and something. So it's really important that you have a plan that helps you capture gains at the high and buy more at the low. Also, to know how much you should actually have, what is safe to have in this particular hot asset. So let's talk a little bit more about that. So that's what our pie chart looks like. This is a 30-year-old who's overweighting 20% safe. There are many reasons for that. We'll get to them a little bit further along in our PowerPoint presentation. But it also tells you how much at risk. So a 30-year-old overweighting safe would only have, half of his portfolio or her portfolio at risk. And then each one of the slices would be about 5%, right? So it's really important for you to have a number attached to that. And FYI, you can do that on our personalized pie charts. It'll give you the exact number based on how much your wealth is, okay? And if you see that you had like a slice of cryptocurrency and it really went crazy high like it did over the last 2 years, and now your slice is about, 60% of your portfolio, it is begging you to sell high. Again, you might think that Bitcoin's going to 1 million and you don't want to sell high because you think it's going to go higher, but it doesn't have to be all or nothing. Trim it back to one slice or two slices if that's all you can convince yourself to do. Keep that money, and especially if it's in a tax protected retirement account, which you can do now with these Bitcoin trusts or the Ethereum trust, no capital gains. And then if we do hit a crypto winter where it loses 67% like it did in 2022, then when that slice becomes a sliver, it's not like half of your wealth just became a sliver. It's a slice became a sliver. You kept all that wealth and you can buy low. So that's how this plan is actually a buy low, sell high plan on autopilot. You set up your pie chart appropriately, and then you just rebalance it once, twice, or three times a year. Or if we're using our financial house metaphor, you spring clean, you at least spring clean once a year, maybe twice or three times a year. So, what do you think is hot? Quantum computing, AI, electric vehicles. I've put in a lot of different ideas here, and you can take a picture of this. But what I'm going to show you over the next few slides is that each one of these is a little different. So, it is important for you to stay with me while we talk about the difference between the Magnificent Seven and air taxis, or the Magnificent Seven and quantum computing. So, is the good news already priced in? What I mean to say with that is that if stocks are at an all-time high, are you buying high? And is that a plan that helps you not just buy high. That way, if the market's correct. Look, in April, they were down 20%. And a lot of times people say, oh, I'll wait for the crash. Well, were you buying in April or were you more worried that it was going to continue crashing? And now you might be super happy that it recovered and you might be saying, oh, I'll buy more. And that's how our emotions are on the wrong side of the trade because when things do go down, we think, oh, I shouldn't do that. I better hold on, right? So you don't buy low. And then when things go up, you're like, well, this is doing great. It must be fantastic. I'm going to buy more. So you're buying high. And there is a better strategy, and we're going to talk about that as well. So again, if you're interested in some of these hot industries that are trading at an all-time high, let's say that you had $1 million, 500,000 was safe, 500,000 at risk, which is 50,000 per slice. Instead of just buying $50,000 of artificial intelligence or NVIDIA, there is an artificial intelligence ETF. It's called ARTY. It's offered by iShares, just dollar cost average in. So you might say, okay, I'm going to take 2 years to fill up my $50,000 slice. And maybe you do 25,000 this year in one, two, three, whatever chunks you want to do. And then the following the next year. Now, as you're doing this, if the price goes up, it fills up the slice for you. And if it fills it up to your 50,000 before you continue your dollar cost averaging, just stop, right? And if the price goes down, instead of saying, dang it, I lost money, you're going to say, wow, I'm so glad I'm dollar cost averaging. Now I can buy more at a lower price. Okay. So anything that's trading at an all-time high, if you don't already have it and you do want to get hot, dollar cost average. Now, what about quantum computing? And this one is very different. So why does an industry with such potential have a stock chart that looks like this? And there are a couple reasons for it. The first reason is that the companies, first of all, the Magnificent Seven companies are the ones that are mostly investing in this. The smaller companies, it's major cash burn. We've seen a lot go bankrupt. So it's really high risk because they aren't really making any money yet. So this particular quantum computing ETF, when you see these big spikes, it's a marketing. So it's a pay to play. It could be a pump and dump. I'm not going to go that far. I'm not accusing them of pumping and dumping it intentionally, because I haven't researched it. But I can say that it has the classic symbols of a marketing pay to play. So they market it and they say, you should be buying quantum computing, and this is the ETF you should be buying. And they spend money doing that. They might even hire influencers and pay them to say they're doing that, even if they're not. And then you are the one caught holding the bag while the insiders sell, 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 sell. So again, the second thing is the fund itself, the fund company itself. So we've seen a lot of trouble in fund companies that are young or undercapitalized. So I say you should only buy funds from fund companies that have a very high credit rating and are publicly traded so you can check and see, what their financials look like. Okay. So that's why in our, retreats and in our sample pie charts, we use iShares because it's owned by BlackRock and it's got a AA credit rating. I think it's an AA minus. This particular company, we don't know how it might be. I just started my fund yesterday.com, right? So be very wary of that, of the actual who owns that fund company. So again, Magnificent Seven companies are investing in quantum computing. So if you would like to, perhaps that's what you should be thinking about. It's zero tier. 1 to 3 times a year rebalancing is important in even hot industries, right? Because it's important to remember that when things go down, everything can go down. So you don't want to just do buy and hold when you have, stocks that do this kind of thing, because every time the stocks go down, you can lose a lot of money and it's very hard on you personally. You think, oh, I better sell now. So you're selling low. And also, in addition to it being bad for your health, it's bad for your FICO score. So it's really not a good idea. Again, keeping the right amount safe, if you're 50 and you're overweighting 20% safe and 30% lose half, you lose 15%. And you have all that money that you can buy low with. So we will talk a little bit more about the safe side as well, because a lot of people are not safe enough. Now, another thing is, should you invest in robotaxis when air taxis might fly within a year? Now, the truth is, there's probably going to be both air taxis and robotaxis. But you should also be aware of the challenges, many of them safety challenges of Tesla Vision, which is what the Tesla robotaxis are going to be operating under, and LiDAR, which is what Waymo uses. Now, go to nataliepace.com/blog. The most recent blog is this one, Get Safe and Hot with One Easy Plan. I'm also going to be linking to Air Taxi blog that I just did so that you can easily access it. I think I linked to it. Okay, there we go, right here. And the quantum computing blog I did that you can learn more at. So read this. And I also did one on robo-taxis that I think it's important for you to read. If you scroll to the bottom of every blog, you'll see it. Tesla Vision versus Waymo LiDAR. And I will also put these in the description of this particular video conference so you can easily access it. So basically, a NASA engineer, he tested both the Waymos, which is based on LiDAR, a lot more accurate, and the Tesla's full self-driving that's based on Tesla Vision. And it's both entertaining and informative. And there is a link in that particular blog, so I do encourage you to watch it. Obviously, this is not a blog on, LiDAR versus Tesla Vision, but I think it's important for you to watch it. So how does that relate back to what we're doing here? Is that these are individual companies, right? Tesla's individual company. Archer Aviation, which just got the contract to provide air taxis for the Los Angeles Olympics. It's one, right? And when you have these young, well, Tesla's not so young, there's actually an electric vehicle ETF that you could actually purchase that might have a little bit of Tesla, but a lot of Chinese EVs as well. But if you want to invest in an individual company, most of the time, the right answer, not in your nest egg. Consider it Vegas money, money you can win or lose, right? And we can teach you how to have more winning on your side. We definitely do that in day two. But in your nest egg, in your money while you sleep, don't try to look for an air taxi ETF, the same reason you wouldn't look for a quantum computing ETF. And why wouldn't I just put Archer Aviation or Tesla into my plan? Because they have such volatility, right? And that's not money while you sleep. When you have one company and you got to watch and see, okay, is the CEO doing something that's making the stock drop? It's stressful. If you had Boeing as an individual one, you'd be really stressed out for the past 5 years, right? So much easier to have a fund that has a bunch of companies in it. So that's one of the other distinctions I wanted to make is the difference between individual companies, which I would invest with Vegas money, and funds, which can actually reduce volatility in your portfolio, make it much easier. So we're going to talk a little bit more about the safe side. We have this asset bubble chart and the debt. You hear about 36.2 trillion public debt. You don't hear about $102 trillion in total US debt and loans. And that includes the corporate debt and household debt and state debt and all of that. So we live in a debt world, and that it creates a problem for anybody who wants to earn fixed income on the safe side. So what I'm saying is even very high net worth clients who have managed portfolios and they are being put into these assets that may earn a little income, but they lose so much principal immediately. And then of course the broker salesman is saying, oh, it's only a paper loss, right? You just hold it to term. Well, if you looked at the details of the term, some of those holdings would be like a junk bond with an 85-year term. Are you going to live that long? And by the way, what are the odds that a junk bond might have to restructure its debt and lock in those paper losses? So we have to be super careful on both sides because, as you can see from this chart, bonds, which are supposed to be the safe side that earns income and doesn't lose your principal, lost 26% in 2022. It lost more than stocks did. And this was at the heart of why we saw those five banks fail in early 2023. We won't go into how, this is still a problem for banks and insurance companies and pension funds, a lot of these different types of assets that actually have loaned money, especially to, long term to commercial real estate and other things that are a bit distressed right now. So again, it didn't make it back in 2023, and then in 2024, it lost even more. So this is a real problem. Now, I'm not going to go into a bond masterclass, but I just had one. And if you would like access to that, register for our retreat and ask me for access to that, and we'll do it, okay? But you must say that I promised you that, and you must register for the retreat. So the bond masterclass will give you all the ins and outs. I'm just going to say, look, you can see here that if you have S&P 500 stocks, you can sell them. Look here, even if you have Dow Jones Industrial Average stocks, they are not as liquid, right? And that has a lot to do with debt, a lot of the same problems that we see on the bond side. So, just the thing that you want to do with bonds is you want to keep the terms short and the creditworthiness high. You want to think outside the box. You want to observe the federal insurance levels, and you don't want to put all your eggs in one bank. Now, the problems are paper losses, duration risk, credit risk, liquidity risk, yield versus cost risk. I go over all that in the bond master class. But if you're just being told, oh, they'll cut interest rates and that's going to save bonds, that is not the problem. It is all of these other problems that are the problem, and they do not go away with a few cuts in interest rates. So, the Magnificent Seven doubled in 2023. They were the all-stars of 2024, but they were the worst performers in 2022. So, as you can see here, the S&P lost 19.44%. Again, that's where capturing gains, keeping your money, acting at your age, overweighting safe protects you from those losses, right? If everybody else is losing half and you only have 30% at risk, you lost 15%. If everybody else is losing 67%, you didn't invest in Tesla there. You invested in your Vegas money, right? And hopefully you didn't lose because you were buying low and selling high, which is what you got to do when you're babysitting. So Tesla lost 66%, Bitcoin lost 67%. The ARK Innovation Fund, so everybody's hearing about Kathy Wood and what a great stock picker. And she is, honestly, she is. She's a good stock picker. But the problem is that the hottest companies on Wall Street are the ones that lead down and perform the worst. And so, what is your protection? It's not being a great stock picker or this year and being a terrible one next year. It's actually making sure that you are age appropriate, overweighted safe, properly diversified, and that you are capturing your gains at least once a year so that you're keeping the money instead of riding this wild Wall Street roller coaster. All right, so there's that age appropriate plan again. And there's even more details on the safe side. So you can take a picture of this if you want. I don't want to read every single thing. If you're watching this back, you can actually pause it here. But, our easy as a pie chart nest egg strategy, which again, you can do a personalized pie chart of your own with our free web apps. Just email info@nataliepace.com and ask for your free web app. It does all of these things. It puts us on the right side of the trade. It encourages to capture gains. So it's telling us to do what we should be doing, right? It's taking the emotions out of it. It takes the guesswork out of it. By the way, this is enthusiastically recommended by Nobel Prize winning economist Gary Becker. People that were using this strategy actually earned gains in the Great Recession. And this is pretty important. We talked about, so this is Nilo Bolden. She's one of the people I just drew that simple chart on a napkin. She did it and she made gains in the Great Recession. And, a lot of her bosses lost over half. And it took about 6 years to crawl back then. In the NASDAQ, the NASDAQ, the dot-com recession, NASDAQ lost 78%. So $1 million goes down to $220,000. And it took 15 years to come back. So it's really important that we keep this age appropriate, properly diversified plan that we're capturing our gains once, twice, or three times a year. And that's Gary Becker. He actually wrote the forward or the preface to Put Your Money Where Your Heart Is. So stocks are very expensive. I talked to you about that when I showed you the chart, and I said that stocks are very close to their all-time high. And that's why if you don't have a hot slice, dollar cost average in. And that's also why if you haven't done this kind of diversification and make sure that you are age appropriate and properly diversified, you need to do it now. Why not do it now when stocks are high so that when you're making your changes, you're selling high? It's human nature that people fix things when they're broken, but when that comes to our money, that can wipe us out. So I do encourage us to fix the roof while the sun is shining instead of waiting for the natural disaster where we have to recover. So again, even in April, during that tariff sell-off, listen, the stocks dropped 20%. The Magnificent Seven dropped a lot further. They were the worst ones. So, these guys, whatever they say, can move Wall Street, but so can when people get freaked out, like war and that sort of thing. Targeted funds help to smooth out the volatility of investing in just one company. Regular rebalancing helps to keep us on the right side of the trade. Basically, that is to sell high and to buy low. Like if you're just looking at your brokerage statement, it's actually prompting you to do the wrong thing because it's got a stop sign and a minus sign. So it's saying you lost, you loser, you better stop. And then in on the ones where you've made gains, it's got a green light and it's got a plus sign. Oh, you're winning. You're winning. Let's keep winning, right? And in actuality, when things are high, that's when you want to be thinking about capturing gains and it's not all or nothing. And when things are low, that's why you want to think about, oh, should I be buying low, right? Most people don't buy low because they can't. If you lose too much money, you don't have the money to buy low. So again, if you wait for the headlines, it is too late. The recession announcement never comes until at least 7 months after we're in a recession. So we were warning you based on the economic signals in December 27th of 2007. The high was in October of 2007. By the time that recession was actually announced, and by the way, they went in and begging for money in TARP in October of 2008, and then the recession gets announced in December, right? You'd already experienced 35% losses, and then it went on to lose 55% and take almost 6 years to crawl back. This is the NASDAQ, right? We were saying it in Christmas of 1999. And then, of course, look, this is well before 911. A lot of people thought that stocks went down in 911 and they actually went up in that three month period. They had gone way down, starting their plunge actually in March of 2000, right? So we were a little early. The exact high was March of 2000. We were 3 months early. So again, email info@nataliepace.com, ask for access to your free web app, personalize your own pie chart, and get an idea of what you should be having and how much you should be keeping safe. Again, get safe and hot in one easy plan. You can also join us at our online financial freedom retreat. That's October 11th through 13th. It's online, so you can attend from anywhere. And if you register by the end of this month, you receive a complimentary coaching session and the best price because we're in the early bird pricing period. We also have investor IQ tests. So you can ask my assistant for that at info@nataliepace.com. And I did promise you that if you want the Bond Masterclass recording, you just ask her for that when you register. You're going to have to register for the retreat in order to get that. So thank you for joining me. I'm going to stop it here for just a moment and see if anybody has any questions. Obviously, if those questions are really good and we need to, I will record the answers for you. All right, so this is a question about the safe side. And at the retreat, look, what's hot and what's safe changes every year. So before I completely answer this question on what's safe this year, I do want to go back and show you a slide that I actually put in the PowerPoint presentation. I went over it pretty fast though. So this one. So look, bonds have been a problem for a long time, and it's had a lot more to do with credit risk and duration risk. So we've seen just as an example, over half of the S&P 500 is at or near junk bond status, so the lowest rung of investment grade. And that's been the case for a while. You weren't getting paid since the Great Recession, you were not getting paid anything. Like the only way you could get 4% is to go into a junk bond, and then you were at risk of losing principal and paper losses and all of that. So at that time, if you came to the retreat, what we were saying is, hey, go buy a house and rent it out. Now, what happened to real estate between this was the exact sample pie chart in 2012. So what happened to real estate between 2011 and now? It doubled, right? So it's not every year that you're going to earn a measly 4%. But if it is a year where you're going to earn a measly 4%, let's keep it safe and liquid. In other words, let's have access to our money. Let's earn that 4% because 4%, on $1 million is $40,000. So that's a good chunk of money. It's not that much if you only have $100, but if you have enough money, it is something that you want to do. Now, you can easily, at most brokerages, buy certificates of deposits from banks that are FDIC insured. And the reason I say this is that what I've seen at some of these banks is that if you buy a CD with them, and again, I would observe FDIC insured levels. So you can only have it's everything inclusive, right? You can't have like a CD and a bank account, and a checking account, savings account all at the same bank and say, oh, well, I only have 250 in each account, so it's good. No, observe the FDIC insured levels total in that one bank. Now, what I've seen with these banks is let's say they'll say, okay, great, you're going to do a 2-year CD. And at the end of that, if you don't tell them, okay, I don't want you to roll it over, or I do want you to roll it over, if you don't get on them and tell them, they will roll over it for you, but they give you a reduced rate, a very, very small rate. Whereas on the brokerage, if you're selecting these certificates of deposit offered by those same banks, you can actually select right then and there, do I want the money returned to me or do I want it to roll over? I would suggest you want the money returned to you. And a lot of people say, oh, rates are going to get cut. Yeah, but they're not expected to go down to zero. We're expected to get a 0.5% rate cut this year, maybe towards the end of the year. And if inflation kicks up, and that's not like not that is a possibility because of tariffs increasing prices. So if inflation kicks up, they may have to raise rates. I would say that's not a likely scenario, but it is a possible scenario. So anyway, yeah, so certificates of deposit, observe FDIC insured levels, decide how much that you don't need to have access to for XYZ period of time. Also realize it's only 4%. Even if you go 5 years, there may be some other opportunities in 2 years, and you'll be kicking yourself that you made that commitment for 5 years. So, and if you're a high net worth individual, look, even, Microsoft is borrowing, Google's borrowing, Meta is borrowing. So you can even diversify in some very credit worthy, cash rich corporations. You just have to be very, you have to do a lot of due diligence on it, right? Because you don't want to get stuck with a Boeing or a Ford bond where they're at the lowest rung of investment grade. And Boeing has a negative outlook. I think Ford may too. So Ford has been sliding in and out of investment grade and junk for many, many years. So I hope that answers the question. Obviously, and one question answer is not as much as I can give you. And we spend one full day on what's safe at our financial freedom retreat. And also, those of you that have attended and you're like, okay, I'm not sure if I got this right. Remember, we give you access to the recording. You can go back and watch it. But for a lot of us, you wouldn't expect to speak Chinese just landing in China on the first day. So it does take a little while to get, to get all of this set up. And if you need help, extra help, and you want to do it now because stocks are high, why not do it now? I do have private coaching. And I can look at what you own, I can show you what you should own, and I color code it. Like this one's really not good, and here's why, and here's a better choice. You're the boss of your money. You can choose to do it or not, but that's what second opinions are good for, is that they say, okay, here's another opinion. And by the way, I don't sell financial products. I have no incentive to sell you this versus that. My whole incentive is to make you the boss of your money so that you give me my best testimonial. Okay, so I'm going to go ahead and stop it there. I want to thank the people that ask me questions. Always good to have these. If you are a volunteer, remember you can email questions to me. We have it on the list and I'll answer them and you can watch it back. Email info@nataliepace.com. If you guys are not already following me, be sure that you are because I'm not going to email you every day, but I do post on social every day. So be sure that you're following me on your favorite social platform, whether it's Facebook or X or Instagram or LinkedIn. There's our email. You can go over to my Substack. Be sure to subscribe there. This is going to get posted on YouTube and Substack, but what if you missed it? What if your ISP stuck it in spam? At least Substack may go into your normal one. So, yeah, and remember the June 30th deadline because you want that free coaching session and you definitely want to get the best price and the free bond masterclass if you ask for it. Thanks again for joining me.